Hello everyone, welcome back to Almus Market Mornings, your daily dose of financial update with your host Shikhar Garg. Now, as we mentioned in our yesterday's commentary, we had FOMC minutes released yesterday, and the markets reacted quite a bit to that update. Equities saw some red color throwing up, while yields moved, and currencies also had some reaction to the kind of update we've received on the hawkishness of the central bank. It is also seen that our central bank, which is having its MPC going on, how do they react and come up with their inflation activity as well as managing the rates. So, Pankaj, I'd like to know, what do you think RBI would be doing about the MPC, as well as what should we be expecting out of the markets with the kind of inflation being persistent and geopolitics not showing any signs of ending?
Thank you, Sika. Good morning, everyone. So today we shall start with an Indian MPC expectations. While requirements are very conducive to raise reverse repo rate by 40 basis to 375, along with shifting to the neutral stance from accommodative. But MPC may continue with the status quo, citing growth risk due to high oil prices and Russia-Ukraine conflict. Now we should be coming to long-term part of the curve. An Indian 10-year bond is likely to inch towards 7% if RBI puts inflation forecast 5.5% plus and growth below 7.5%. Why this revision in forecast is required? Because when last time they met and they considered crude oil prices somewhere closer to maybe around 65-70, which is currently now at 90-95. Even if they take that in account, 95, the inflation might shoot up to 5.5%, because that comes with a lots of logistic issue across the globe, and that will be impacting us. Russia-Ukraine conflict has also put primary articles such as wheat and all those things at a higher prices. So this will be having an impact. Market would be looking whether it will be Operation Twist or GSEC acquisition program for yield capping. So these would be the few important points which would be market would be looking from MPC expectations. Wall Street had another weak session, starting with the hangover of the previous day's Bernard speech, which triggered fall and got intensified as FOMC minutes, showed that the policymakers are ready to raise 50 basis point as an incremental rates, and as soon as a winding up of a Fed balance sheet, as soon as the month of May begins. This statement of Bernard was really extremely negative on the sentiment that she has been known though among the policymakers. When we come back to minutes show that there is a consent to cut up to USD $95 billion a month. People have actually calculated what could be a optimum size of a US balance sheet, Fed balance sheet. It should be somewhere closer to 470 to $5 trillion. But currently, I think it's around $9 trillion. So there would be a months of quantitative tightening would be happening. It was once against the growth stocks which have taken a heavy toll of the selling, because if rates goes higher, the growth stocks will be taking some kind of a hit. What we are seeing on the other part of the globe, where the China still vows to use monetary tools, policy tools to stimulate economy at appropriate level. And there is some kind of a rumor today morning. Chinese TV was citing premier meeting their senior officer to take this decision. Dollar has continued to stay bid against the major and the EM currencies after the FOMC minute, and that looks like that might continue for some time. The yield curve inversion noticed on Friday and Monday, which had got reversed now. Now 10-year yield is higher than the 2-year yield. Coming to euro, which was to be sold on a Tuesday evening, had got some respite on Wednesday morning because of a strong reading of a PPI inflation in the Eurozone. USD JPY also moved higher, but that move was a gradual. Chinese yuan, which has taken a big knock after the yesterday's shock fall in the services PMI, has recovered to 6.36, but market would be looking that it might move towards 640. We have also seen some good profit taking in commodity-related currencies like Aussie, New Zealand dollar, and Canadian dollar. Oil prices have seen some kind of a profit booking, and it could not clear the hurdle of 110 level Brent oil, so it moved back to 102. There is some price up move, and today dealing at 103.50. Coming back to rupee, rupee had a sharp reversal yesterday following the jump in dollar index after the key Fed members spoke about faster pace of rate hikes and immediate need of a rapid balance sheet tapering. The surge of inflows which we have seen in first 2 days of the month seem to have been well absorbed, and strong demand took the rate higher above 75.75 and closed somewhere closer to 75.80. The pair sort of further during New York hours as the US yields moved higher, and there was a reported statement, from US authorities that would like to see if they would not like if they see rapid acceleration in import of energy from Russia. That's all from me. I think we should be seeing a range of today 75.65 to 76.15 today.
Okay.
That's all.
Okay, that was quite good, Pankaj, and a few things to remember that there can be a hike in reverse repo rates from as well as a small change in stance from accommodative to neutral in the Indian embassy, which is being going on. On the benchmark front, we did mention that there can be some corrections and a move towards 10% is possible. But what needs to be seen is RBI's approach towards managing the yields, whether it's going to be an operation twist or any other operational approach. The $95 billion worth of QT by the US Central Bank can be also, a move towards reducing the kind of liquidity that the market is having, while a sharp reversal, as we saw in USD INR, was somewhat surprise for a lot of market participants. But let's see how does rupee behave with the MPC on the backdrop. Till then, we have this update for today. We'll catch up again tomorrow. That's it for today. Thank you so much.